So do want to get a check on the travel sector for the month, mainly red, but a few highlights here as we finish with the closing bell here on Wall Street.
That closes out what has been a tough month here for the markets. Like Jared was just saying, all three of the major averages ending the month of August in the red, and also the day in the red, as you can see on your screen. The Dow closing off 279 points, S&P off just around 0.8%, the Nasdaq off about 0.5%. Let's bring in Victoria Fernandez, Crossmark Global Investments Chief Market Strategist, and Octavio Marenzi, Opimas CEO. Great to have you both. Victoria, let me start with you. Great to have you on set.
It's a pleasure
by the
to be
way.
here.
Certainly moving on from what has been a tough month here for the markets, Nasdaq was the hardest hit when you take a look at the losers here during August. How does this set us up heading into September, which historically speaking, seasonally speaking, is an extremely tough time here for equities?
Yeah, and it's usually even tougher when you're going in on the downside, which we're doing obviously from today. But, you know, back at the beginning of the year, we said, look, this is going to be a year that's really volatile. There's going to be a lot of push and pull going on. We saw that the first half of the year, and I think many people thought by the time we got to the September Fed meeting, we'd have a better plan of action, things would calm down, and yet we're not. I think it's even happening more so, more volatility, which to us means you've got to position yourself, not all in on any particular sector. Position yourself to where you've got some staples in your portfolio. You've got a little healthcare, a little defensive names in there. Doesn't mean you can't find places in the market for specific areas, specific names that you like, but I think you want to take a little bit of a risk-off approach here, not knowing exactly how far the Fed is going to push us.
And Octavia, obviously that's also being dominated by a lot of this economic data that we have coming out, especially when we look at the housing sector. What's giving you the most concern, and what are the signals that you're tracking the most closely?
Well, I think the housing sector is certainly one that doesn't look particularly promising. We've, of course, had a couple of negative GDP readings. We've seen jobless claims inching up. Initial jobless claims had sort of a bit of low in July and have been inching up since then for the past couple of months. So I think there's a whole bunch of economic indicators that are looking very, very bad. And I think we're sort of in store for a crash landing, or a very hard landing at least. And I think in contrast to prior cycles like this, the Fed is not going to be in a position to sort of lower interest rates and boost the markets. And that's what they've traditionally done. When the economy slows down, the Fed cuts interest rates, they boost liquidity into the market, and the market responds very favorably. And equities prices and stock prices benefit from that. This time round, if you take Jay Powell at his word, what he described on Friday, they're not going to do that. It sounds like he's factored in. He's going to hurt the stock market. He's willing to accept some unemployment going up. He's willing to accept a recession to get inflation under control. And that's going to be really bad. And it's a sort of a confluence of events that we haven't seen for decades in the markets. Every time for the past 50 years, basically, when markets have gone down or the recession looks like it's coming around the corner, the Fed has lowered interest rates. This time around, it looks like they're not going to be able to do that. And I fear the worst here.
Wow, there is a lot of bearishness around this studio today, because earlier Michael Kantrowitz told us he sees an S&P bottom around 3,400, meaning we're going to retest those June lows. Do you feel that is in the right territory?
Well, I think it's a tough call right now. I mean, typically when you've done that 50% retracement level from the lows like we saw last week, you continue to do well and you continue to have kind of a bull market from there. But, I mean, we saw Jared looking at the sectors earlier, utilities, energy. Utilities does not normally lead you out of a low in the market into a new high, into a new cycle. So I think you've got a lot of kind of conflicting elements that are out there. I don't see us going into recession this year. I do think we have a slowdown. I think we have a growth, which we're seeing. And you see kind of a rotating recession between different parts of the market, like housing that we were just talking about.
Octavio, I'm going to put a similar question to you. You said, quote, crash landing. How bad do you think it could potentially get? We've talked about retesting those lows back at what we saw on June 16th. Are we heading even lower?
Well, I think the Fed is really the only game in town here. So it's all about what is the Fed going to do and not do. And I think when we saw those lows back in June, remember what the Fed had said basically in earlier in May. They said we're going to start to wind down our balance sheet. We're going to sell off our bonds. We're going to sell off our treasuries and our mortgage-backed securities. And that, of course, was going to put a tremendous amount of pressure on bond prices and drive interest rates way up. What the markets then saw is the Fed was not terribly serious, really, about reducing its balance sheet, or only reduced it by a very, very small amount. And on the mortgage-backed securities side, hasn't reduced it at all, really. It's basically been the same level for the past 6 months. So what Jay Powell's speech on Friday basically outlined was, yes, we are going to do this. We are going to reduce those levels. So once the Fed starts to sell its mortgage-backed securities, bear in mind, they're sitting on close to $3 trillion of mortgages. Once they start to sell that, they're going to push mortgage rates higher, and that's going to put even more pressure on the housing market. And we've seen tremendous slowdown already in housing, and that's going to get worse. And interest rates there on the mortgage rates are going to go higher. So I think that's really where we're going to start to see some real pain is in the housing sector, and that will then have a ripple-on effect into other sectors in the economy as well.
Yeah, those mortgage-backed securities are a real interesting space to keep your eye on. Victoria, what could be the catalyst? We got a jobs number Friday, September, I think, 13. We get the next inflation print.
Right.
Either one of those or neither?
Probably both of those. I mean, we know how much weight the Fed is putting on these numbers, although they say they're going to continue. So I think even if you get a number, so good news is bad news is good news somewhat at this point in time. I think there are people that are rooting for maybe a not so great jobs number on Friday, like the ADP report today, because that tells us, yes, it's weakening. That's what the Fed wants to see. It'll start to bring wage pressure down, inflation come down, and the Fed can maybe ease a little bit. I'm not so much in that camp. I think the Fed is going to continue to go. We're going to get to that neutral rate of around 3.5, 3.75. And until then, they're going to keep moving regardless of what the numbers are. But it will shape probably the momentum in the market from both jobs and inflation.
And Octavia, in your notes, you talk about manufacturing sales being down 1.5% year on year, saying this only happens in recessions. What should we make of this data then? And how hard is it to really try and seep through the tea leaves to try and really understand the condition that the economy is in right now?
Well, I think it's clear. I think the economy is in a bit of a spot of bother at the moment. So it's not drastic. We're not seeing big reductions in terms of GDP, but certainly the last two readings on quarterly GDP were down. Most people would consider that to be a technical definition of recession. And a whole bunch of other indicators are looking in the same direction. So manufacturing sales are down. We see the yield curve being inverted. We see bank lending standards being tightened. There's a whole array of factors that are pointing in the same direction. And I'm afraid when all these things start to point in the same direction, I think you can assume that things are going to go further that way. And so I'm quite negative and quite pessimistic. And like I said, the Fed is not going to be able to bail us out. We're sort of heading into a recession with no monetary policy to help us.
Well, we'll end on that doomish note. A big thank you there to Victoria Fernandez and Octavio Marenzi. Thank you both for joining us this afternoon.